We learned about China's recent economic position in the previous video, but in this video, we'll learn about China's economic prognosis in 2023. Despite the real estate slump and the slowdown in exports, the Chinese economy is still growing at around 4%, with stabilization being given top priority and the recovery trend centered on domestic demand improving as a result of the relaxation of the zero-COVID quarantine policy under the policy of stable growth. It is anticipated to see growth at the second half rate. Economic activity will slow down in the first quarter as a result of the sharp rise in COVID-19 infections, but, in the second quarter, growth will pick up as a result of the base impact of the previous year's sluggishness and the rebound in consumption. Recovery is anticipated to accelerate. With the smooth progress of the reopening expected to have a decisive impact on the performance of the Chinese economy in 2023, there are concerns that domestic real estate market stagnation and externally, the US-China conflict, interest rate hikes in major countries, and the prolonged crisis in Ukraine may act as downside risks. Consumption will initially show a slight improvement, but as the recovery picks up steam in the second half of the year, it is anticipated to return to its pre-COVID-19 level by year's end. Numerous forecasting organizations predict that China's retail sales would increase by about 6% in 2023, above the average growth rate, 3.9%, for the previous 2 years, 20 to 21 years, WIND. Early on after the reopening, consumer spending is anticipated to recover slowly as consumer confidence deteriorates amid a steep decline in economic activity brought on by a sharp rise in the number of sick persons and rising unemployment and income concerns. The recovery will start in earnest in the second half of the year, focusing on in-person services like travel, dining out, housing, and tourism. Product consumption is also anticipated to rise. However, real estate-related consumption, such as that of furniture, building supplies, and ornamental items, is predicted to slowly recover given the persistence of the real estate economy's sluggishness. The resurgence of domestic demand is crucial for the steady expansion of the Chinese economy, thus it is anticipated that the Chinese government will intensify policy support for rising employment and incomes as well as other measures to increase consumption. Investment in high-tech businesses and new infrastructure continues to demonstrate a positive trend in terms of fixed asset investment. However, investment in real estate development is still sluggish. Many predicting organizations predict that fixed asset investment in China would expand by more than 5% in 2023, above the average growth rate over the previous 2 years, 3.9%. High-tech manufacturing will see a rise in investment, but the growth rate is anticipated to be limited due to weakening international demand brought on by the global economic downturn. It significantly outpaces the total investment in manufacturing, 9.3%. The majority of SOC investment will go toward new infrastructure, but existing infrastructure investment may decline slightly if the consumption recovery picks up steam as a result of reopening. It is anticipated that policy backing for improving urban functioning would grow significantly. Despite substantial regulatory support on both the supply and demand sides from the Chinese government to stabilize the real estate market, real estate development investment is anticipated to remain sluggish for the time being due to declining investor sentiment. Exports are anticipated to expand at a rate of about 0% in 2023 as the pricing impact that has helped fuel export growth has decreased and external demand is predicted to remain weak as a result of economic slowdowns in key economies. Exports to developed nations like the US and Europe will decline, however exports to RCEP nations like ASEAN will marginally rise due to increased demand for bypass exports for tariff reduction. In addition to new energy vehicles, it is anticipated that exports of solar products, basic organic chemical products, and secondary battery components would remain robust. On the other hand, if the rapid rise in infected people and the social unrest caused by the quick lifting of the COVID-19 quarantine are not stabilized in an early stage, it is possible that production and logistics problems due to a loss in labor force may adversely affect exports. As domestic consumption gradually improves, imports will also rise slightly, focusing on capital and consumer goods. However, the rate of increase is anticipated to be limited to around 2 to 3% due to the decline in raw material prices brought on by the global economic slowdown and the decline in imports of intermediate goods as a result of weak exports. It is anticipated that loosening fiscal and monetary policies would be put in place in an effort to get out from under the three stressful circumstances of declining demand, startling supply, and deteriorating expectations. Fiscal policy will continue to be active in order to address uncertainties during the early phases of reopening and to guarantee steady growth and employment recovery. Fiscal deficits will also be directed toward investments in new energy, cutting-edge research and technological infrastructure, stable jobs and a resurgence in consumer spending, as well as healthcare and sanitation. There is a chance that the scale may increase to about 3%, exceeding the goal by 2022, 2.8%. Expansion of exclusive bond issuance compared to the previous year, and investment in important national infrastructure through the issuance of financial bonds by policy banks are expected to continue. Policy capacity may be constrained as worries about the financial stability of local governments persist in some segments of the financial market. For example, a decline in sales revenue of land use rights due to the weak real estate economy, minus 25.9% compared to the same period of the previous year during January to October 2022. Financial planning. The People's Bank of China is anticipated to implement monetary policy, such as increasing the scope of the special re-loan program's operations and further lowering the reserve requirement ratio for financial institutions, to strengthen the real economy's support during the COVID-19 reopening and the current economic stimulus. Scientific technology innovation, support for carbon reduction, enhancement of coal usage efficiency, special re-loan programs suitably adjusted operational limit to encourage growth of high-tech manufacturing industry and migration to a low-carbon green economy. On the other hand, despite the continuation of an accommodating monetary policy, it is still difficult for small and medium-sized businesses to obtain financing, and the availability of liquidity is insufficient as a result of the weak demand for credit brought on by weak household consumption. However, this is a 5-year bond issued to stabilize the housing market. The potential exists that the loan prime rate, LPR, will decrease soon. To stabilize the real estate market, the People's Bank of China has announced 16 financial support measures for the real estate sector, November 2022. More lenient and tailored credit policies will also be revealed around the 2 sessions in 2023, anticipated in March, in addition to aggressively ordering extra loans, maturity extensions, support for bond issuance, etc. to real estate developers. Expected. We looked at China's economic prospects for 2023 in this video. This film finishes by stating that China's future economic prospects are promising. We will discuss the most critical major topics in the following video, so kindly subscribe to watch the next video.